Let's begin the capital gains related amendments part. So these are the amendments that were there in the Finance Act 2023. In the supplementary material, there are no amendments on capital gains. So better watch these amendments video for sure, because it is very important, this capital gains related part for sure. So these are the broad amendments that we have, after Finance Act 2022. So in the Finance Act 2023, these are the amendments that were brought in the capital gains. In this, I personally feel 50AA amendment and taxation of electronic gold receipts. These two amendments are very, very crucial. And the next crucial amendment is section 54 and 54F. Two amendments for the section 54 and 54F, where maximum the investment in the new house property shall not exceed 10 crore. Indirectly, the maximum exemption is restricted to 10 crore. These are the main key amendments. And by the way, for the previous year 23-24, nothing but assessment year 24-25. If at all you transfer the capital asset in 23-24, the index number is applicable is 348, which means nothing but when you're calculating indexed cost of acquisition for long-term capital asset, getting it for the purpose of computing long-term capital gain, the numerator, year of transfer, if at all year of transfer is 23-24, then 348 is the number. If at all you are an old scheme student who prepared capital gains based upon previous year 20-23, getting it, where some 331, some number is there, whole number. If at all you followed with that, just it's a number change, automatically amounts will change. So you need not worry about, sir, you have learned it with the Finance Act 2022 and nothing to worry. It's just a number game. Only the number has been changed. Now, there are two amendments, mainly 50AA, electronic gold receipts, and 54-54F. Typically speaking, I call only these two amendments are typical from my point of view. Fine. So let's begin without any delay. So by the way, what is the index number that is applicable for the previous year 23-24? 348. In exam and all, you need not remember index numbers. They will give you index number. Year of transfer, they'll give you index number. Whatever financial years they used in the question, no, for all those years they'll give you index number. You need to clearly pick what is the right index number applicable for the given problem. By the way, please watch the marathon on the capital gains. Open a marathon video, go to the timestamp, capital gains timestamp. Watch that entire, approximately some 2 hours 15 minutes marathon I have uploaded on capital gains in that particular entire full video. Watch that, then you continue watching this, and I'm telling you, you're going to get goosebumps clarity in capital gains. Fine. So one amendment is, of course, index number. Another amendment is 50AA. I'll come back to 50AA a little while later. First, I will talk about electronic gold receipt taxation. Or let us do one thing. Let's talk about 54-54F taxation. Then I'll go to electronic gold receipt. So 54-54F, very simple. You all know in 54, what is 54 section? Where you're transferring a house property, you're also, and you got a capital gain. That too, it's a long-term capital gain. You transfer a house property, which is used for residential purpose, and you got a capital gain, and the capital gain may be more than 2 crores or less than 2 crore. If at all it is less than 2 crore, you can buy 2 houses. If the capital gain is more than 2 crore, you can buy 1 house. Now, whatever the asset that you are going to buy, right, new house, whatever amount you invested in the new house, right, that is eligible for exemption. That is eligible for exemption. Generally, whether it is 1 house or 2 houses, whatever it is, you are having time limit of 1 year before the date of transfer per purchase, 2 years from the date of transfer per purchase, 3 years in case of construction. And whatever amount, if at all you don't want to purchase immediately or construct immediately, before filing IT return due date, before filing the return of income, before the due date for filing IT return, the entire amount that you want to invest and claim exemption, you have to deposit in the capital gain account scheme. This is what you learned in the 54 section, correct? Now, in the 54 section, the new house that you are purchasing, right? If at all the new house value is more than 10 crore, if at all the amount invested by you on the new capital asset which you purchased for the purpose of claiming exemption, if the amount invested is more than 10 crore, the excess amount shall be ignored. That excess amount shall be ignored. Remember, they did not say exemption is restricted to 10 crore straight away. Here I told you for your convenience purpose. In the original law, in the original Income Tax Act, they did not say exemption is restricted to 10 crore. They didn't say like that. But they indirectly restricted exemption by saying amount invested in the new house more than 10 crore shall not be considered. Amount invested in the new house for more than 10 crore, that excess amount is not considered. Even if you deposit under section 54 in capital gain account scheme for more than 10 crore, that will not be considered. That's what the department said. That's what the act, the taxman said. Are you getting it? So indirectly, what are they saying? Amount invested in the new house cannot exceed 10 crore. I mean, if at all exceeds 10 crore, that excess amount is ignored, right? Indirectly, maximum exemption that you can claim under 54. Maximum deduction is 10 crore. Similar amendment is brought even in 54F. What is 54F? You are transferring any long-term capital asset other than house property. Other than house property, you are transferring any long-term capital asset. Maybe a land also you are transferring. And where you are acquiring, what asset you are purchasing to get exemption, you are purchasing house property. What you are purchasing actually, you are purchasing house property. And if you recollect, in 54F, no, whatever amount you invest, you will not get exemption. You will get exemption based on a formula. What is the capital gain and how much amount you invested and what is the net consideration you got. Please watch the marathon if at all you are unable to recollect. Please watch the marathon if you are unable to recollect and then continue watching this. Fine. So how the 54F exemption is calculated, what is the gain and how much amount to be invested, what is the net consideration actually to be invested. In this proportion, exemption is calculated. Here, the amount invested more than 10 crore in the house, right, shall be ignored. So up to 10 crore amount invested only will be considered. So in 54F, no, maximum amount to be invested in the new house shall not exceed 10 crore for the purpose of calculating, exemption. I have given you page reference. You know, this is the page reference, page number 75 in capital gains. After you just open capital gains, inside that 75. Getting it? You open capital gains, inside that 68. I say study material, I'm telling you. If I don't know whether you follow which material, right? Because this video I'm going to upload on the YouTube also. Getting it? That's it. So these are the two amendments. Please remember, MCQ might come. That's it. This is one important amendment in capital gains. Then we have another amendment that is relating to taxation of electronic gold receipts. You know, SEBI has given vault manager rules. There is something called vault manager rules. Vault, V-A-U-L-T, vault means nothing but a locker. They are maintaining a locker. Getting it? So vault manager rules in 2021. In India right now, there are some 3 registered vault managers. 3 registered vault managers were there in India. Just a minute. Right now I will show you. So this is the link. Vault managers who are registered in India. I'm just showing you. Just 2 minutes hardly. Now you see here that the link has been opened. So you see, these are the 3 registered vault managers. Registered vault managers who got registration from 2022 year onwards. 2022 year onwards. Getting it? So what is this electronic gold receipts? Very simple. To promote electronic gold holding. To promote holding of electronic gold, SEBI has introduced a new concept called electronic gold, vault manager, electronic vault gold related vault management services. Getting it? So what happens there? You know, very simple. If you understand this, you know, in ICA Metal they have not given any problem, but we don't know in the exam a problem might come. Getting it? We don't know. So what they are saying is, suppose if I have a physical gold of 1 kg, suppose if I have in home physical gold of 1 kg, I don't want to use it anymore, and I also don't want to sell it. Because no, the gold is appreciating like anything. In the past 3-4 years, gold is appreciating really good. Getting it? Especially China is buying gold from the past 2 years. From 2022 year onwards, China is aggressively buying the gold. So the price is increasing. Steeply it is increasing. So I don't want to sell the gold. But at the same time, I don't want to maintain the physical gold in my home because of the theft, bulgery, all that. I don't want to. So what option I have? One, I have an option of converting this into gold monetization bond. That option is there, but I felt that is not interesting also. So you do one thing, you submit your physical gold to a vault manager and get a gold receipt, electronic gold receipt. You get electronic gold receipt. You get a receipt, electronic receipt. And you know what? This receipt can be traded in stock exchanges. This receipt can be traded in stock exchanges. This is something like a script. This is something like a security, shares and security. Just like that, you can trade it in. Yeah, I'm sorry. So this can be traded in the stock exchanges. This can be traded in stock exchange. So just like a shares and securities, electronic security kind of. Now, what is the capital gains treatment for electronic gold receipt? If at all physical gold, no, I know physical gold, if it is held for more than 36 months, it's a long-term capital asset. And if you transfer this gold, you have long-term capital gains while computing this indexation facility, all that and all we know. What about electronic gold receipt? Now, you know, actually what I'm doing is, I am converting my physical gold into electronic gold receipt. I am converting, right? Is this conversion treated as transfer? Yes. But section 47, 7D, a new clause has been inserted in 47 where they say, what they say, conversion of physical gold into electronic gold receipt with a vault manager as per SEBI vault manager rules, that is exempted transfer. Means the conversion from physical gold to electronic gold receipt is not. Finally, okay, I converted into receipt. Suppose I want physical gold back. Suppose I sold to somebody this electronic gold receipt. He want to get a physical gold for the receipt. He can surrender this. He can surrender this gold receipt to the vault manager and get physical gold. Conversion of electronic gold receipt back to gold. Conversion of this receipt to gold. That is also not treated as transfer under section 47. So 47 clause 7D, which says that conversion of physical gold into gold receipt, conversion of gold receipt to physical gold is not a transfer. Why? Because we are just changing the shape of the gold. That's it. We are not actually selling gold to somebody and encashing it. We are just converting physical gold into a digital gold back to physical gold. So where is the transfer here? Where consideration movement? Where is the consideration? Where is the profit and all? So section 47 says it is exempted. This is not a transfer. Fine. What about, okay, suppose sir, I have a physical gold. I convert it into electronic gold receipt. Now can I sell this gold receipt to somebody? Absolutely you can sell. This is not exempt, man. This is not covered under 47. This is taxable. This is taxable. Oh, fine. So if I sell electronic gold receipt, if I transfer the receipt to somebody else, it is taxable. Now, how to compute electronic gold receipt related capital gains? Just like a gold. Suppose I purchased my gold in 2021, April 2021. I converted this into April 2023. I converted this into electronic gold receipt in April 2023. I sold this in the June 2023 in the stock market to somebody. This receipt, I sold it to somebody in the stock market in June 2023. Now, whether this electronic gold, actually what I sold, remember, what I actually purchased is gold, physical gold. I converted into gold receipt. This is not a transfer under section 47. Now, this receipt I sold to a third party. This is treated as transfer. Capital gains will apply. Now my question is very simple. Now I sold in June, right? Is this gold receipt long term or short term? First of all, for electronic gold receipt, what is the period of holding criteria? 36 months only. Now, sir, I got this receipt in April 23. Sir, I sold it in June itself. June 23, which means less than 36 months. Wrong. That is not the period of holding. For electronic gold receipts, period of holding includes previous asset holding period. Previous asset before the receipt is what? Physical gold. Whatever the physical gold that you have right earlier. Suppose you are the original owner who converted the gold into electronic gold receipt. That receipt now you are selling to somebody. Now this receipt is a long term or short term? If this receipt is a long term or short term, to calculate period of holding, physical gold you held right before conversion, that period will also be considered. Which means in my hands, April 2021, I purchased physical gold, right? Conversion happened in April 2023, right? Ultimately sold in 2023 June, right? Which I sold electronic gold receipt. Is this a long term or short term? From which date period of holding will you consider? From the date of creation of the receipt or from the date of purchase of original gold? Original gold. Since April 21 to 23, let's assume it is 24. Since April 2021 to April 2024, sorry, June 2024, this entire period is considered. More than 36 months. It's a long term. Accordingly, indexation facility, all that is available. This is one clarification which they give. In the period of holding, section 2, subsection 42A, they clarified this. Now fine, suppose this electronic gold receipt, I sold in the June month for, let us assume 1.5 crore. What is my cost of acquisition? Electronic gold receipt I got because of converting my physical gold. Whatever my physical gold cost is there, that is the cost of acquisition. Cost of acquisition of electronic gold receipt is nothing but physical gold cost. Physical gold cost, I got it for 1 crore multiplied by index numbers of the year of transfer, index number of the year in which first held by the SSE. So reduce that, you will get whether it's a whatever, the long term or short term or whatever it is. So simple, long story short, what I'm trying to tell you, if at all you purchase physical gold, you convert it into gold receipt, that conversion is not a transfer. Gold receipt you are selling subsequently to somebody, that's a transfer. What is the full value of consideration? You know, minus what is the cost of acquisition? Cost of acquisition of gold receipt is nothing but cost of acquisition of the physical gold. Now, whether it's a long term or short term, from when you purchase the physical gold, from that date till the date on which you are selling electronic gold receipt, right? That entire period is considered for determining whether it's a long term or short term capital asset. Got clarity? Fine. Now, let's look at the buyer of the receipt. Suppose now I sold receipt to the buyer, somebody. Suppose no, Mr. A sold electronic gold receipt to Mr. B buyer. So I am the one who bought this gold receipt. For me, what I can do with this gold receipt? I can hold it, or I can submit this to vault manager and get physical gold. I can get physical gold. Now, suppose no, I purchased gold receipt from you. You sold me for 1.5 crore. You sold me this electronic gold receipt for 1.5 crore. You sold me this receipt for 1.5 crore. For the first time, I am buying gold in the digital form. That's it. For me, it's the first time buy. For me, I bought. In which year I bought? 23, 24. Or else let us assume 24, 25 year I bought. For the first year. Now, what I can do with this? I can hold it for 36 months. From now, I can hold it for more than 36 months and sell it. And long-term capital gain might get. Or what I can do is, 24, 25 I got, right? I went in 25 and 26 to vault manager. I went to vault manager and I surrendered this gold receipt to vault manager. What I did? I surrendered the gold receipt to vault manager. Means I am converting gold receipt to physical gold I got. This conversion is exempted under 47. This conversion is exempted. Fine. No tax treatment as of now. You know what I did? In 28, 29 previous year, whatever physical gold is there, no, I sold it for 3 crore. The physical gold I sold. Remember in the previous example, I have a physical gold originally converted into receipt and sold receipt. Now you see, I purchased the receipt first, then converted into physical gold. That gold I am selling for 3 crore. Now how to compute capital gains? First of all, full value of consideration is what? 3 crore minus cost of acquisition of this physical gold is what? Originally you didn't buy the gold, you bought the receipt. In exchange of the gold receipt, you got physical gold. So the cost of acquisition of physical gold will be the cost of acquisition of the electronic gold receipt. So 1.5 crore. Now is this a long term or short term? You know, you converted into physical gold in 25, 26, right? You sold it in 28, 29, right? Now physical gold you sold. From which date you will consider period of holding? Conversion data? No. This gold you got physically because of the gold receipt conversion which you purchased in 24, 25. So when I purchased gold receipt, no, from that date period of holding I will consider. Are you getting it? From the date of purchasing gold receipt through which I got physical gold now, gold receipt holding period will be considered. Getting it? For physical gold which you got in redemption of the gold receipt, the period of holding will be considered from the date of acquisition of the gold receipt. Same way, for physical gold, for gold receipt, period of holding will be considered from the date on which gold was originally purchased, through which it is converted into receipt. Are you getting it? Suppose no, I purchased gold receipt. I did not convert it into physical gold. I directly sold it to another party. Now, from the date on which I purchased till the date on which I sold, that is the gap I will consider. If it is more than 36 months, it's a long-term asset. Otherwise, it's a short-term capital asset. This is what amendment is in the Finance Act 2023. So, I will show you in the book, don't worry. So, section 47, in that clause 7D has been added. What are they saying? Any transfer of capital asset being conversion of gold into electronic gold receipt. If you are converting physical gold into receipt or conversion of electronic gold receipt back into gold, getting it? It is exempted because it is covered under section 47. This conversion from gold to receipt to gold is not a transfer. But if you are selling it to a third party after conversion, that is a transfer. Now, when you sold to third party, it's a transfer, it is liable for capital gains. What is the cost of acquisition? Cost of acquisition of receipt is nothing but cost of acquisition of the gold. Cost of acquisition of gold is nothing but cost of acquisition of the receipt. You getting it? Now, so what is the cost of acquisition? Suppose if the asset is a capital asset being a receipt, which is issued by a vault manager, it became property of the person because of the conversion. You converted physical gold and then got EGR. Now EGR you are selling it. What is the cost of acquisition of EGR? That is nothing but cost of gold you purchased. Getting it? In whose name EGR is issued. Suppose where gold is released against a EGR, means you purchased EGR and you surrendered to the department, you surrendered to vault manager and you got a physical gold. That physical gold you are selling. Physical gold you sold. Physical gold you are selling. What is the cost of acquisition of physical gold? You sold this gold not by directly purchasing the gold. You got this gold by surrendering EGR. EGR you paid some amount, na? The cost of EGR in the hands of the person, that is the cost of acquisition. Same way, where electronic gold receipt is issued in respect of gold deposited. Getting it? The period of holding for such gold, the period for which gold was held prior to the conversion. So, for electronic gold receipt, while computing whether it's a long-term capital asset or short-term capital asset, while computing this, while considering this, you have to consider gold holding period. Physical gold you held, right? That period. Same way, when gold is released in conversion of EGR, you surrendered EGR and you got gold. That gold you are selling ultimately. Now, whether this gold is a long-term or short-term, EGR holding period shall be considered. The period for which EGR is held prior to conversion, that will be considered in the period of holding. So simple. If at all you have not got the clarity, don't worry. Once again, play the past 10 minutes. Once again, that's it. Slowly watch, neatly watch. Don't watch at higher speed. That's why you'll not get clarity. Watch at standard speed. So clear example it took, along with the taxation. In the institute book and all, nothing. They just gave these 3 points. Nothing they gave. I in fact told you very clearly what is the period of holding is applicable with examples and all I told. Just make use of it. Then one more amendment, cost of improvement. Earlier for goodwill and all, cost of improvement is to be taken as 0. Now for any other intangible asset of a business, for all intangible assets, cost of improvement shall be taken to be nil itself. Straight away nil. Cost of improvement for all intangibles is straight away taken as nil. No more argument. Then finally, one more important amendment, that is section 50AA. That is section 50AA. 50AA is talking about computation of capital gains in case of market-linked debentures or specified mutual fund. Specified mutual funds or market-linked debentures. So 50AA is talking about taxation of market-linked debentures, specified mutual funds. Until before 50AA, just a minute. Yeah, sorry for the interruption. Yeah. So 50AA is the new section. Until introduction of 50AA, until before 50AA, market-linked debentures, they come under 36 months criteria to decide whether it is a long-term capital asset or short-term capital asset. Suppose if this market-linked debenture is a security listed on a stock exchange, 12 months only the criteria. Getting it? If at all it is listed on a stock exchange. If at all it is not listed on a stock exchange, it comes under 36 months criteria, debentures and bonds, unlisted securities other than shares. Getting it? 36 months criteria. But now what section 50AA says, you know, section 50AA has a overriding effect in spite of anything contained in 2 subsection 42A, 2 clause 42A. What they say, you know, 50AA, market linked debentures, specified mutual funds, they are always short-term capital asset irrespective of holding period. This is the first stroke. The market linked debentures and specified mutual funds, they are always short-term capital asset. So first of all, what is a market linked debentures? Are they really practical? Yes. There is a company called Piramal Enterprises Limited which have issued market linked debentures somewhere in 2019 or 18. Getting it? The market linked debentures were getting famous now. Getting it? In market linked debentures, no, principal is guaranteed by the company. But the interest amount which they pay on the debenture, right, that is not a fixed percentage. That depends upon the market movement. So these debentures, no, the rate of interest, the return on these debentures to investors, no, is decided by the market forces. So it's one more way to attract investors, to attract lenders. Getting it? That is market linked debentures. Another one is what? Specified mutual funds. Here, many students will not observe one point. Market linked debentures, whether you acquire before 1/4/2023 or after 1/4/2023, when you acquire doesn't matter. If you are selling it in the previous year 23-24 onwards, if you are selling, suppose this 23-24 year I sold some market linked debentures, it's always a short term capital. Sir, when I purchased this market linked debentures, you purchased in 2019, 2018, 27, doesn't matter. You are selling it after Finance Act 2023 is implemented. It's a short term capital asset. Suppose if I sold this market linked debentures in 20 to 23 financial year, previous year, at that time 36 months criteria, 12 months criteria, whatever is applicable, that only we will see. But from 1st April 2023, if at all you are selling any market linked debentures, it's always a short term capital asset, no indexation. Of course, debentures by default, no indexation. But specified mutual fund is there? No. Specified mutual fund, section 50AA we will apply only if the specified mutual funds are purchased on or after 1st April 2023. Only if the specified mutual funds are purchased on or after 1st April 2023. If the specified mutual fund is purchased after 1st April 2023, then only section 50AA will apply. Suppose I purchased some mutual funds specified which comes under 50AA specified mutual fund. Yes, the definition. Yes, the definition under 50AA, some mutual funds I purchased, it falls within the definition. But I purchased it before 1/4/2023. Before 1st April 2023, I purchased. It will not come under 50AA. Getting it? It will not come under. Now, if a specified mutual fund purchased before 1st April 2023, now whatever criteria, suppose if it is equity oriented fund listed on the market, 12 months criteria. If it is debt oriented fund, it will probably come under 36 months criteria. But if at all the specified mutual fund, what is a specified mutual fund? Very simple. It's nothing but maximum in equity, not more than 35% of the total proceeds are invested in equity shares of domestic companies. So maximum 35%. So how much in this mutual fund investment goes to equity shares? Equities of Indian domestic companies, maximum 30, maximum 35, means minimum 65% or more than or equal to 65% of the amount of the mutual fund is invested in other assets other than equity. It may be debt, or it may be real estate assets, or it may be any other assets which are there in the market. So that's called specified mutual fund. That's it. Now here, percentage of equity shareholding will be computed based upon daily average of annual average of daily closing balances. Whatever daily closing balances 365 days they list out, and average of annually they'll consider. If it is less than 35%, that's a specified mutual fund. Getting it? What is a market linked debenture? It's nothing but a security which has an underlying principal component in the form of a debt security. So underlying concept, it's actually a debenture where the returns are linked to market returns on other underlying securities or indices, nifties, Sensex, all that. It includes any security which is classified or regulated as market linked by SEBI. So SEBI will specify the list of securities which are treated as market linked. They are also market linked. So that is market linked debenture definition, specified mutual fund definition. Now remember, specified mutual funds 50AA section can be applied only if the specified mutual funds are purchased on or after 1st April 2023 and then you sold, then 50AA is applicable. Suppose market linked debenture, you may be purchasing it before 1/4/2023 or even after 1/4/2023. That doesn't matter. Is it a market linked debenture? Yes, it's a 50AA. 50AA section will apply. So automatically to decide whether market linked debenture is a long term or short term, specified mutual fund acquired on or after 1st April 2023, long term or short term, you need not apply all these 24, 12 or 36 or no confusion. Straight away there's short term capital asset. Fine, agreed. Okay, now how to compute capital gains? Very simple. Suppose I sold specified mutual funds which I purchased after 1st April 2023. I sold it now. Whatever sale price you are getting, that itself is treated as full value of consideration received minus as reduced by at what price you purchased the debenture or at what price you purchased the unit. Check out. And the expenditure incurred for wholly transfer expenses, you reduce that. Cost of acquisition you reduce, transfer expenses you reduce. The balance would be deemed to be capital gain. Remember, the concept of indexation will not come for market linked debentures. Indexation concept itself is not there, but specified mutual fund. Remember, specified mutual fund, if at all they were purchased before 1st April 2023, if at all they were purchased before 1st April 2023, indexation concept possibility is there. Indexation concept possibility is there. Specified mutual fund purchased before 1st April 2023, 50AA section will not apply. So in that case, this can be either a long-term capital asset or this can be either a short-term capital asset. In such a case, if it's a long-term, indexation is available. Are you getting it? But if the specified mutual fund is purchased by the SSE on or after 1st April 2023, it's always a short-term. Obviously, indexation will not come into picture. Clear? Next. So capital gain arising from transfer or redemption or maturity of a unit of a specified mutual fund acquired on or after 1st April 2023 or market linked debentures, whether acquired before 1st April or after 1st April, doesn't matter, would be deemed to be a short-term capital gains and chargeable to tax at normal rates of tax. It's a short-term capital gain. Remember, 111A and all will not come here. So it's a normal capital gain. It's a short-term capital gain which is taxable at normal rates of tax. Normal rates means what? SSC specific rates of tax. Sir, what is normal rate, special rate? Just watch the marathon basic concepts. You will get a clarity on that. In the marathon, just go to basic concepts timestamp. That's it. You will get it. Appa, that's it. Entire capital gains amendments is also over. Almost 30 minutes we spent. So capital gains arising from transfer of market linked debentures and units of specified mutual funds would always be capital gains arising from short-term capital asset, irrespective of period of holding of that asset. That is what provided in 50AA. And many students know here they are thinking short-term capital asset definition has been modified like this. No. Short-term capital asset definition is not modified. In the diagram, ICA book, they just mentioned for clarification purpose like this. Original short-term capital asset definition 2 clause 42, if you see, there is no amendment inside that. 50AA only amended. 50AA inserted. No, this have a overriding effect. The 50AA section starts with notwithstanding anything contained in 242AA. It starts non-obstante clause. I hope you are confident on capital gains, all the amendments. 50AA, electronic gold receipt taxation, cost of improvement for intangibles is treated as nil. 54, maximum investment in house cannot exceed 10 crore. 54F, maximum investment in house cannot exceed 10 crore. Clear? By the way, please watch the marathon on the capital gains. Open the marathon, open the timestamp capital gain. Watch that. You will get a best clarity.